Welcome back to Trendlines Over Headlines, the show where we break down the markets with some of the best traders and analysts out there. We've got a good one for you today. John Roque of 22V Research is returning to the show. A lot of you might remember him. We had John on a few weeks ago. If you missed that episode, definitely go back and check it out after this. But a lot's happened since then, and I'm continually amazed at how well John has called it this year. He's one of the most respected technicians on Wall Street. He's worked at multi-billion-dollar asset managers like Soros Fund Management and Key Square Capital, so we're really lucky to have him back on, and I can't wait to hear what he has to say. But first, it's Friday, the markets are closed, so let's take a quick look at how this week played out. Hey guys, thank you for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. All right, so the major indices closed lower for the third straight week. The Dow led, but it still fell about 3% on the week. The Russell 2000 lagged, falling nearly 5%. Now let's take a closer look at the S&P 500. Last Friday, we looked at that failed breakout above the June highs. As we know, failed moves often lead to fast moves in the opposite direction, and that's exactly what we saw this week, a fast move lower. We fell 4 out of 5 days this week. We sliced right through the 50-day moving average like a hot knife through butter, and that was really the bull's last line of defense, so it's really hard to find anything bullish to say here. We could easily retest those June lows, which are about 6% lower from here. Now, looking at the sector performance, all 11 sectors closed lower by more than 1% this week. Utilities outperformed, but they still fell about 1.5%. Technology lagged, falling 5%. Now, my next guest has been consistently bearish since November, and he's been spot on. So without further ado, let's welcome John back onto the show. John, welcome back to the show. It's great to see you.
Thanks, Patrick. Always a pleasure to be with you. Thanks for having me again.
Yeah, thank you for coming back on. The reason I wanted to bring you back on is because a lot's happened since we last spoke, right? And just to give some context here, the last time you were on was mid-July, just 2-3 weeks after that June low, and you laid out a pretty convincing bearish argument, and it really didn't start playing out until last Friday. In the interview, we spent a lot of time talking about bear market rallies and how they can be seductive or beguiling, I think as you called it. And you said on a potential counter-trend rally, you thought the S&P 500 could probably make it to about 4,200. You called that the Mendoza line. But you said you'd probably be a seller if we reached that 4,200 level, and we did reach it. In fact, we overshot it a little, ultimately found resistance at that 200-day. And I gotta admit, even after our conversation about bear market rallies and how seductive they can be, I still got fooled. You know, I got pretty bullish when we broke those June highs, that 4,200 level, whatever you want to call it. I got pretty bullish, and you had a lot of encouraging things, right, that suggested maybe we were in a new bull market, like bread thrusts. You even had some positive news about student loan forgiveness in terms of stimulus, you know. But of course, that breakout ended up failing on Friday. We're back below that Mendoza line. I texted you on Friday. I was like, I got blown out of all my longs today. You were right, essentially. And so, you know, they say out of failed moves come fast moves in the opposite direction, and we've certainly seen that this week, right? I mean, we're recording this on Thursday, but the first 4 days of this week have been pretty brutal. So at this point, we're down about 9% from those recent highs. What are some of the levels you're watching here, and do you want to be pressing shorts at this level?
Okay, well, thanks, Patrick. Thanks for the lead-in. Key levels to me are 4,000, and we're kind of flirting with it now. I don't think it's going to hold. I think essentially the S&P is in a position, and I'm going to say this softly, not to be overly dramatic, from which it really cannot rally strongly from. just given the position of the index relative to its 50 and 200-day moving averages, this is not a strong position. If this were, and please, the only thing I'm good at this is as my sister says, coming away with bruises. But if you're in a jiu-jitsu class and this is your defense, you'd have to abandon your defense because it's not good enough. And so I think in order for the S&P to rally, it has to get lower. And I think the action we've seen off of what is D in my chart, which was a near 62% retracement of the decline, I think this is just more bear market action. And I do think this is an area where you do want to press shorts, mostly because it's difficult to do. I also think that we're likely in an area where we might see an acceleration lower in this part of the cycle relative to the prior part of the cycle. And if I'm right about that, then I think what we might see is that the stocks that have held up relatively well so far do more poorly than the stocks that have been hit hard so far. Because I think we'll come down to the point where people will say, I have to sell whatever I can sell. And that would likely mean the things that have held up much better. But I do think it's right to press shorts because it's hard to do. Most of the people that I speak with here are reluctant to do it. In fact, I'd say, a good number of them are expecting some counter trend rally where they'd rather set the shorts up higher out. But we had a counter trend rally. It was about 19% in 40 days. Some stocks were up much more than that. And I think that this is just bear market action. It was difficult. And you used my word, which I'll use it again. You were up 19% in 40 days. It was really kind of drawing you in to get bullish. And I do think, Patrick, and you'll confirm this for me because you see a lot of other technical work, and I don't see much of it except what you put out in your daily emails. So thank you. But there was a lot of people who do our job who are quick to jump on the rally because they claimed it was significant in a Fibonacci form. And I didn't think it was significant because we found these over time. And some of the charts that I've showed you, and you got a copy of my chart packet. I did a webinar yesterday, and my title of my webinar was Who Was Marty Zweig? And I think what is most ironic here about Marty Zweig is that he had his two most famous rules were don't fight the tape, which the tape is pretty terrible as far as I could tell. And the second rule, equally as famous, was don't fight the Fed. And what's really remarkable to me from the people that I speak with is that to a man, nearly everybody wants to buy bonds. Nobody wants to short bonds here because they think the Fed is going to do their job and the economy is going to slow. But the bond market yields don't believe it. In addition, there are many equity investors who don't believe the Fed. That's a curious juxtaposition because on the way up for the equities, when the Fed was, let's say very dovish or loose, they wanted to believe the Fed. But now, because the Fed wants to tighten financial conditions and is telling you that they're going to fight inflation tooth and nail, people don't want to believe that. I think that that's a very important and strange dilemma that's not going to be resolved well.
Yeah, I mean, I'm a huge fan of Marty Zweig. Don't fight the Fed, don't fight the tape. I mean, very wise words of wisdom there. And, it is interesting how during that fake out, you did see the narrative kind of shift to, the Fed's going to pivot, And of course, Friday on the Jackson Hole, I mean, it was a pretty clear message. Is that right?
I agree with you. And I think our business has become kind of a microcosm of social media at large. Because I found, and I think you might agree with this, that in social media, it's important to be first, not necessarily correct. And I think in our business, it has become seemingly as important as it is in the social media structure to be first, not necessarily correct. Twain had a great quote. He said, a lie goes halfway around the world before the truth has a chance to put its pants on. And I think appropriating that for our business is the misinterpretation of a market indicator goes halfway around the world before a correct interpretation of a market indicator has a chance to put its pants on. And I think we saw this especially of late with these Fibonacci retracement claims.
Yeah, and I like what you said there earlier about how we could potentially see the things that held up relatively well start to act as maybe a source of funds. If the market's under pressure, maybe people will sell those things that held up relatively well in order to, finance some of their losses. So I wanted to move to some of the red flags that you saw this summer that kept you bearish. In our last conversation, we talked at length about the difficulty of staying bearish in a bear market and bear market rallies. And so, even when we broke that line in the sand, your Mendoza line, you stayed consistently bearish, and you cited some things like semiconductors and Apple. There's an example of a stock that held up relatively well throughout the decline. It broke out to all-time highs on a relative basis throughout the decline, and it got as much as like 4% from an all-time high on an absolute basis. So that one held up relatively well, but you were raising a lot of concern about that. And it was mostly on the fact that Apple, because it held up relatively well, added, you pointed out, $700 billion in market cap. I mean, put that into perspective for us, and why is that a concern? Well,
Apple's market cap addition from its low to its recent high, I think its recent high was August 17th, was $700 billion, as you said, which is greater than every stock in the U.S. not named, Apple itself, Microsoft, Google, Amazon, and Tesla. I thought that was kind of remarkable that Apple could have been doing all of that work. Now, I didn't do the calculations and take Apple out of the S&P and then figure out what the S&P would have done without Apple, but I guess we could just kind of, fake it in that regard. But when a stock could do that much work at that size and not have, let's say, semis participate or financials, especially the big financials participate, I thought that was a little bit curious, number one. And number two is, I do believe that when a bear market low, a good one is made, or a bear market bottom, that we're not going to be led by the groups or sectors that led us up to the top. And the fact that tech was the biggest rally off the low said to me that this was something I should be, viewing a little bit more curiously than some others.
Yeah, so you have here a composite of the 7 largest stocks, and it looks awfully similar to semiconductors, which are another area that you want to see doing well, leading, but they never broke above their June highs throughout that rally. So that was, and a lot of these, these two look very similar, this big 7 and semiconductors, and a lot of them kind of look like a stage 4 decline, classic Stan Weinstein stage analysis.
So I think you're right about that, and Stan did it before anybody else by referencing it like that. But I think if we took the name off of this and it wasn't the SOX index and it was Patrick and John's sporting goods stores, and we saw it rally back into a downward sloping 200-day moving average, we'd have to say it's a good spot to sell this thing, especially if the same thing was occurring relative to a benchmark index, as it is in the bottom panel for the S&P. And on the top panel, there's a 200-day moving average. And in the bottom panel, I use 126 days, roughly half a year. But the top there is important. And in addition, I don't know if you'll show it here or maybe you'll show it later in the compilation, but semis are now worth 8% in the NASDAQ 100. That's their lowest level going back over at least 4 years. Wow. I mean, if semis are deteriorating within the NASDAQ 100, certainly they're deteriorating in the S&P 500, and that's what that chart there is suggesting. And if you just draw the line back, so semis first got to this level in late 2020 on the way up, and now they're on the way down. So I think this is going to be further disappointment in the semis. And it seems to me that maybe we collectively don't really understand or appreciate how much the SOX outperformed both the S&P and NASDAQ over the prior several years. And to expect it to continue to do something like that all over again just seemed misplaced to me.
Yeah. And, one thing I've always admired about your approach is how simple you keep it in terms of trend. I'll tell a real quick story. The first time I met you, I was trying to kind of get a better idea of your style of analysis, and I was asking about the indicators you use and stuff, and you were like, yeah, Patrick, I don't really use indicators so much anymore, besides maybe a MACD. And I was like, what? It didn't make sense to me, right? Like, here you're a great technician. And I was like, so what do you use? And you said Trend. I had a light bulb moment. I thought, what if one of the best in the biz is keeping it, what if his edge is that he keeps it simpler than everyone else out there and just focuses on trend, truly? And I say simple, but that's not easy to do. We talked about how hard it is during counter trend moves to have that conviction. But yeah, I thought that's really interesting, and that's pretty much what you're doing here, right?
Thank you for the kind words. I am trying to do that, and I'm old now, but so I'll tell you what I did when I was younger. So when I was younger, I tried to learn, and back then there was no data from Bloomberg available, so I had to build it all in Excel myself. I tried to learn the ins and outs of every indicator, mostly because I was trying to just create the formulas in Excel and make the Excel charts myself. And so I kept a lot of indicators. And I thought that the more indicators you had, the more likely you would have understood something. And I think over time, what happens is that you get better at analysis the more indicators you eliminate. And so I'm going to tell you a story that I probably have told you before, but I hope you don't cut me off. So here goes. So there was a guy named Paul Slovic who did a horse handicapper study in 1974. And I'm going to fudge the numbers here, but you'll get the gist of the story. And what he did was he measured the performance of horse handicappers based on the number or pieces of information that he gave to them. So, for example, if he gave them 0 pieces of information, they might have a 10% success rate, and their confidence level was probably around 10%. But if he increased their piece of information to, let's say, 9 pieces or 10 pieces of information, their accuracy rate went up significantly from 10 to 17%, as did their confidence rate. But once he got above that level and he gave them a ton more information, their accuracy rate did not improve, though their confidence level soared. And what he showed you from the study is that more is not necessarily better. That's number one. And number two is, I worked at Soros Fund Management for 4 years. And I'm going to tell you right now, I don't know George Soros, so I'm not going to try to say that I do. But when I was there, I tried to learn a lot about Mr. Soros and how he was able to differentiate himself over his time, really putting in great returns or achieving great returns. And I was told by the guy that I did work for that Mr. Soros had a great line, and his line was, "Just give me enough information." And then I was fortunate enough when I worked at Key Square to be in a meeting with the former head of the CIA named George Tenet. And I should have asked him the following question. The question I should have asked him was, "Mr. Tenet, did you learn all you needed to know about running the CIA when you worked in your family's diner in Queens?" But I didn't ask him that question. I asked him the following question. And there's a similar paper on their website as the Paul Slovic horse handicapper study. And I referenced the paper. And I said to him, when you're making a decision, how much information do you wait to gather before you make the decision? And this is going to be self-serving, but he said in front of the group that was a pretty good question. And he said, if it's going to take me 5 years and I get 95% of the information, and I can wait 2 years and get 70 to 75% of the information, he said, I'm making my decision in 2 years. And so I thought that all of those things corroborated the other without necessarily trying to corroborate it. And I think that's where the magic of information comes in. Paul Slovic did the study. It told us one thing. George Soros repeated it in his own fashion. And then George Tenet repeated it in yet his own fashion. And so if it's good enough for those 3 guys, I figure it's good enough for me.
Yeah, it's good enough for me too. And I think what you're essentially describing is analysis paralysis, right? Too many data points. And hey, I see it all the time. I mean, I spend half my day on Twitter looking at research, right? So I'm definitely no stranger to that. But anyway, I want to move on to energy and crude oil, if that's all right. So energy, of course, has been the only place to hide out in terms of sectors of the S&P 500, and it's still the best house on the block. And, you know, it's kind of made a little bit of a resurgence in the last couple weeks, but we're still kind of flirting with those key levels in both energy and crude oil. For energy, you know, if you're looking at XLE, it's around 79.80. For crude oil, that's around 94.95. But, you know, I feel like the past couple weeks we've kind of just whipsawed around them, where one day it looks like we're breaking out and we're back above it. The next day we're back below it, and it's just been kind of confusing. So I want to get your take on energy here. What's your outlook?
Okay, so I'm going to use for anybody who has Bloomberg, CLZ2, which is the December 2022 futures contract. And I've thought, this is Brent, but we can work with this. This is fine. I've thought that the CLZ2 would get back to its early 2022 breakout level, which is roughly around the $74 level. And so Brent is kind of corroborating that. This is a long-term chart for Brent, and it's a weekly chart with a 40-week moving average. You could see that it is having had a lot of difficulty at the 120 level, which, except for 2008, Brent really has not stayed above that level for any length of time. And even in 2008, it was up there for a very short period. So I thought that it was into big resistance, number one. Number two is you got at the end of that chart all the way to the right in 2022, kind of a negative price divergence where it went up and got to 120 again, but the weekly MACD just did not corroborate it. And then in the bottom panel, it's Brent divided by the Bloomberg Commodity Spot Index. And going back to 2008, when you've had these peaks in price, they have often occurred next to or alongside, coincident with peaks in relative performance for oil versus the basket of commodities. So I thought that this was an area from where Brent and West Texas would have some difficulty. And I think oil's still going to work lower. And I also think that natural gas is kind of in an area where it looks like it's going to have difficulty getting above $8. And then if you go back to the chart that you had just before for the, that one. Thanks, Patrick. You'll notice in the bottom panel that MACD for the S&P energy sector, S5 ENRS for Bloomberg, in 2022, it was the only time ever, going back to 2007, that MACD got to a new high above what were prior highs. So the MACD was kind of in an excessive area relative to its prior overboughts. And I don't think that any push higher in this index is going to be able to get that MACD to make a new commensurate high. So I want to be selling rallies in this group because I don't think it's going to be corroborated by the momentum. And then in addition, and this might be trite, but it seemed to work in prior cycles, in order for a good low to form, I think that the market has to come for the pretty girls. And the energy sector, to your point, which you said a few minutes ago, has been the prettiest girl year to date. And this is what it looks like for the Russell 2000 sectors. You could see it's either energy or it's nothing. And energy was up when I put that chart together, 49%. So I think that in order for a good low to form, they eventually have to come for the strongest sector. That's this. And I think the commodity itself is telling us that they're going to work lower.
Yeah, I mean, I've heard that before. In bear markets, they come for them all. And energy definitely has a target on its back. I guess I'm wondering, I know you speak to a lot of traders and portfolio managers. Anecdotally, do you think it's getting to become a crowded trade, or do you think, the fact that it was neglected because of ESG mandates and all that for a decade or so, do you think that has further to unwind? I mean, you can kind of see both forces, right?
I don't think it's a crowded trade at all. I actually think it was more crowded on the retail side. I think retail was responsible for a lot of what drove energy to such outperformance. I really do. Because on an institutional basis, the energy sector was so small in the S&P 500, you could have made up that weighting in a relative benchmark portfolio with just one or two stocks. You didn't really have to have an expansive presence in energy. So I don't think it was institutionally driven. And I do think that it is not an overweight or especially well-owned sector institutionally. I think you're right. The ESG mandate prevented people from participating to a great degree. And I hosted a webinar about a year ago, and my panel was entitled "The Unintended Consequences of an ESG Mandate." I still think that's true. So it might be that energy comes in, but after the low, it could be one of the sectors that leads, and maybe we'll get clues from that by its relative strength versus the S&P 500.
Yeah, well, let's talk about the dollar next. I can't tell you how many times I've thought the dollar was going to roll over this year, but that uptrend has just been relentless. It just keeps chugging higher. I mean, it'll just shake off these negative divergences. It looks like it's going to put in a failed breakout one day, and of course, it just keeps ripping. It hit another 20-year high today. So we call it the wrecking ball for risk assets because it's put a lot of pressure on stocks, crypto, what have you. And the last time you were here, you said you thought the dollar could get to 120, and I kind of balked at that. I mean, that sounded pretty aggressive. But here we are at 109. 120 is only about 10% away. We're up 15% on the year. It's not out of the question. Do you think, is that still your target?
Yeah, 120 is still my target. And if you saw it today, and I know you did because you pay attention as closely as anybody, dollar yen made a new reaction high. Sterling dollar in favor of dollar made a new reaction low. The euro dollar did make a new reaction low, but we know just how weak that is. So I do think this is likely to continue higher. And I had the good fortune early in the year to hear from quite a number of investors who thought that there was going to be kind of a de-dollarization that would occur. Where, of course, then China would be, the renminbi yuan would be a major beneficiary. And I thought that was just kind of a little bit too cute, given how the dollar looked like it was accelerating when that kind of thesis was going around. And so it wouldn't surprise me if this gets up to 120. That's what the breakout implies. I think it's also important to see in the bottom panel, and that's a rate of change, just a 12-month rate of change on the DXY. Prior cycle peaks for the dollar on a rate of change basis, we're kind of getting into the upper end of this range. The only time it was really materially higher was in the early 80s. But as you said, it's your line. I think it's a good one. It's the wrecking ball, and I think that this is something that investors need to be concerned with. And if it were the John and Patrick newsletter hour, and I would think that the major macro risks here, at least as I could see them, are rates continue to push higher. The dollar continues to be strong. Credit spreads are close to breaking out above what is their own Mendoza line. And I think inflation is going to be stickier than most people believe. And I think that's what the action in the yield market is telling us. And I do think seriously that if the business were still run, and I'm not an old crank about this, I'm just trying to be observational. I do think that the business were still run by active management and not passive management, the market would be lower already. But I think it's very hard to believe that algos or passive are programmed to understand what it takes a lifetime, of mistakes to kind of understand.
Yeah, so you mentioned high yield credit spreads. Could you walk us through this chart real quick? You have the dollar rate of change in the lower panel, is that correct? Year over year change?
That's right.
So walk us through this one. You mentioned that credit spreads are kind of flirting with their own Mendoza line. So what is that?
So the high yield to worst spread versus the U.S. Treasuries is about, I think it's 5.4%. I can't read it. My eyes aren't that good at this level. But so getting above 6% historically has coincided with other, let's say financial calamities. And you're going to show a chart shortly, which has some good anecdotal sentiment with respect to that. And coming from Stan Druckenmiller, here it is. And so we'll look at that in a second. But you could see, and I've tried to put in what the financial calamities were when you get above that spread of 6%. You had an oil price shock in the early 90s, then Asia, Russia, LTCM, the tech bubble bursts, et cetera. And we collectively, we at 22V had the good fortune to host Stan Druckenmiller on an early June webinar. It was hosted by Dennis DeBuscher, who's the founding partner here. And so Dennis asked him toward the end of his time speaking to Stan. I thought Dennis should get an Emmy for this because this was a tremendous question and a tremendous answer. He asked Stan, what is something that the consensus has wrong or has mispriced? And Stan thought that there was too much comfort that there would be no financial calamity. And he thought inflation combined with the post-asset bubble period would be particularly difficult. And I think that's proving to be prescient so far. We just haven't had a financial calamity, but it has been kind of an everything bear. And then while I was at Soros Fund Management, I spent a lot of time with Robert Soros, who is a gentleman, and we went over charts a lot, nearly every single day. And we spent a lot of time on the bond market. And he said to me quite plainly, the bond market never lies. And since the early 70s, the bond market is the undefeated and undisputed champion for causing financial calamities. And I don't believe that number 15, which is where we are now, is going to be different from 1 through 14. And you can see in the little panel or legend to the right what each of those prior 14 financial calamities were. And so I'm going to use Stan's line because I think he has the correct read on consensus with respect to the problems. And I think Robert Soros's line is just historically accurate. It's a great, terse, perfect line. I mean, it makes no bones about it. I think he's right. And that's what the chart has told us over time.
Yeah, I mean, you shared this chart a few months ago, and it got a ton of buzz. And your point here was that when yields move like this, something tends to break, right? And so you kind of already answered my question. It's a total softball, but I'll give it to you anyway. Do you think something has broke yet? Have we seen that happen yet, or no?
So I don't think so. I'm not rooting for it because I know how difficult the business can be when it happens. But I'm going to be plain about it, and I'm not rooting for this. But usually in financial calamities, you have some sort of funds that close. And I know that Melvin Capital has closed, and I'm not being pejorative here, or even especially critical, but I think Melvin Capital was actually a 2021 event that actually manifested itself in 2022. We've heard of name hedge funds who have had very difficult years in 2022, but we've yet to hear that any of these have decided to close. Again, I'm not rooting for it because the business becomes harsher and difficult, and people end up losing their jobs. But I don't think that anything is really broken yet. I really don't. Usually the Fed comes to the rescue when something is broken. They're not prepared to come to the rescue here. They're going to actually taper their balance sheet, although it's only down 1.3% from its all-time peak. It moves slower so far than my 93-year-old father. And certainly the S&P rallied back 19% over 40 days. And we've had global market rallies as well during that time. So I really don't think anything has broken.
Yeah, I mean, as big as Melvin Capital is or was, it still doesn't feel big enough to be that type of event that you're describing, or in parallel to some of those other events that you have.
And in addition, and this is again observational, Melvin Capital's difficulties were sequestered to their own investors. There wasn't some sort of broad fallout from it. So I think broad fallout might be more akin to your phraseology of breaking than what we've already seen.
Yeah, and I want to go off script just for a second real quick. I know you keep an eye on inflation a lot, and there's been a narrative, a conversation in the past few weeks that inflation may have peaked. What do you think of that? And what's some of the evidence that you're seeing in favor or against?
I am going to risk being told that I don't know anything about inflation, but I'm going to answer your question anyway. So when the CPI was first at this level 70 years ago, it took 13 months for the CPI to go from current levels where it is now to under 2%. So 13 months. So even if inflation is peaking now, and of course it could, because the rate of change can't continue to go up unabated. There has to be some moderation. There's no doubt. But it took 13 months for it to get from where it is now 8% roughly to under 2%. Okay, so that's number one. Number two is in 1966, when the CPI first moved above 2%, and I realize there are different inputs here, and I'm not interested in the different inputs. I'm only interested in history and what the rate did. When it first got above 2% in 1966, it did not move back below 2% for 20 years. And within those 20 years, it was a 9-year period roughly where inflation was really difficult. Now, I'm old enough to remember when my mother would go shopping and tell my father she didn't have enough money to buy groceries. So it took 9 years for the Fed to get that inflation genie back in the bottle, but it was 20 years before inflation got back below 2%. So I don't think that most people are aware of that. Now, I don't think I'm necessarily ahead of the game, but I've had a lot of meetings and a lot of presentations, and I bring that chart up all the time, and I show the information, and I go through it just like I went through it with you. And I'll be quite honest with you. Nobody has ever said to me, yeah, I've done that data. I know the stats. You don't have to go over that. Nobody said that, not one person. And then just earlier this week, as I've said to you before, I pay close attention to what is said on CNBC, because there's no greater sentiment repository than CNBC, because nobody goes on CNBC and dissembles. Everybody tells what they really believe and feel. And Jeremy Siegel said that, and I'm quoting him, prices on the ground are falling. Now, I'd like to believe that he's telling the truth here, but the bond market doesn't believe him. And a cup of coffee in Venezuela was up 25% this week, so they don't believe him in Venezuela either. And the UK CPI also hit 13% this week. I mean, year over year, but the numbers were released this week. And on a relative basis, the UK 10-year gilt is above its June high, so it's higher relative to its own high than the 10-year yield is. So Professor Siegel's, commentary notwithstanding, the bond market doesn't even believe him. So I think inflation's likely to be stickier than most people believe. In fact, I will tell you also, Patrick, that to a man, nobody wants to short the bond here. They all want to buy them, at least the people that I've spoken with. They want to buy the bonds because they think the economy is going to slow, but yet the bond price doesn't give you any kind of relief that that trade is going to be correct yet. And so I think the sentiment is really kind of screwed up. Most people are expecting inflation to come in. The bond yield doesn't suggest it's going to happen. And more people want to buy bonds than they do want to short them. And again, the bond yield doesn't suggest that that's ready to occur. So I think there are some real competing narratives here. And if we're supposed to be good analysts and supposed to pay attention to price and be objective about it, using the yield as a price tells us something's really amiss here.
Yeah, I mean, I agree with all that. Before you go, I want to get your take on sentiment real quick. My guest last week, Callie Cox, she shared a very similar chart. And we've all seen that. She called it the hype cycle, but it's that classic sentiment chart. And what I thought was interesting about our conversation is I asked her where she thought we were, and she thought more towards like this denial stage, that you have highlighted here to the left. I thought we were kind of more wrongly, I was wrong, more in that relief stage. And I thought it was interesting that we were so far apart on where we might be. I think it's Walter Deemer who says, if you need an indicator to tell you sentiment's at an extreme, it's not, and therefore it's not useful. So I'm totally lost on sentiment right now. What is your read on it?
So I tend to agree with Callie Cox, and Walter always has the greatest line. So I think he's right about that. I think we are kind of in denial, and I think we moved quickly. And I'll just tell you, this is not my graphic, so thank you to whoever made it. I want to tell you straight out, it's not mine. So I think we went quickly from denial to relief without ever experiencing any of the stages of grief between those two. And when you get a 19% rally in 40 days, it becomes kind of difficult to stick with, the kind of cautious viewpoint. And I'm sure you will tell me, I'll ask you, you don't have to answer the question, it could be rhetorical, but how many of the people that, you kind of see work from regularly changed to become more aggressive or more bearish or more constructive? So I think that there's, kind of a portion of this hype curve, as Callie would refer to it, or as this, whatever we want to call this here, the life cycle of the market's emotions. I think there's a part of it that hasn't yet been solved. But if we get through or get into the, acceleration phase, I'm quite certain that we're going to get through those sentiment inputs there that we haven't yet seen.
Yeah, what's really interesting is if you think back to June, right before the market was bottoming, we were kind of falling like crazy. And everybody was looking for capitulation. Everyone said we need capitulation in order to end this down move and, rebirth a new cycle. And we never really got that capitulative move. sure, it was weak and it was painful, but you didn't get that like kind of throwing in of the towel, that panic selling that you would normally see as capitulation. So do you think we still have yet to see capitulation then?
I don't think it's yet occurred. I really don't. I don't necessarily know that we'll get it. Maybe it ends with a whimper rather than a bang. But I guess the history would suggest that we should look for it. But volumes have been pretty light. That may be a function of being late August, now early September, that volumes have been light. You know, people will say no liquidity. That's true. I mean, the VIX really didn't get up to 40. That's another thing. Put calls really didn't soar. They've elevated a little bit, but they haven't really soared. And, you know, to your question from some time ago when we first started this, and my comment is, I think people don't want to press shorts here. So I usually, you know, when people will short anything, you tend to get concerned, and I don't think that's happening here. And I just heard today, you know, from somebody else in the business that they thought that if you have a 5 or 10-year horizon, this is a good time to start buying semiconductors. And so I kind of replied, well, if you have a 5 to 10-year horizon, that's usually a good time to start buying anything. Yeah. But I don't think that, you know, while people will like to tell us they have a long-term time horizon, I think those long-term time horizons are kind of made up of a bunch of short-term time horizons. And especially if you have to perform to get paid, I don't necessarily think that people want to make too big of a bet in that regard. So I'm always curious when people throw out those platitudes in difficult environments, because I think they do that to kind of make themselves feel better about their decisions, or at least holding on to losing positions.
Platitudes like what? Like I'm buying for the long term?
I'm a long-term bull. The market will be higher 5 years from now. Yes, of course, because the market's built up, right? The whole business is built up. And except for 4 lengthy sideways periods going back to the late 1800s, you know, you are up. But I also think it's important to consider that we haven't had a sideways period for a long period of time. Most people in the business, and I'm sorry to pull the age card, haven't experienced a real bear market. And certainly, me included, almost nobody is still around who's ever experienced the combination of a bond bear market and an equity bear market at the exact same time. And because we're getting both of those at the exact same time, it should tell us that it is different with respect to recent history. And we should probably use a line that, you know, I used in a note from some time ago: choke up. We should choke up on the bat and not take big swings. We should try to hit the ball the other way. We should maybe, you know, not swing at certain pitches. We should only swing at strikes. And I think because people have, you know, recency bias, they want to continue to buy every dip. But I think this is the era or period where it's especially difficult because you have the combination of a bond bear market and an equity bear market at the same time.
Yeah, you know, you show that one chart, it's, I think, the S&P or Dow going back like 100 years, and you highlight those decade-long periods where the market went nowhere, and you're just kind of making the point that, you know, a lot of people haven't experienced that. And I think that's a really interesting point, and something we should, you know, entertain as a possible scenario.
I agree with you. Thanks, Patrick.
Well, John, I could sit here and pick your brain all day, but
well, I don't know if you get much more, but I'd enjoy talking to you, so don't worry about it. Thank you for having me.
Yeah, likewise. Absolutely. Thanks for coming on the show, and I hope you have a great long weekend.
You too, Patrick. Thanks again. Hope to talk to you soon.
Take care.
Thank you.
All right, thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week.